Hi, you're at Real Turkey channel. My name is Atilla Yesilada and we're in Istanbul. We talk Turkey, nothing else. Today I'm going to talk about the decision by the Turkish Central Bank to raise rates by 350 basis points. This happened last Thursday, but I was extremely busy with Turkey's political developments, so the video is a couple of days delayed, but it's still very relevant. Essentially, I'm going to try to explain why central bank felt the need to suddenly change course and raise rates, because it was expected to cut rates throughout the year uninterruptedly. Two, the political impact. Three, economic impact. And four, most important question, how long will the central bank keep rates at the very high level? Last Thursday's Monetary Policy Council meeting was supposed to be a non-event. There was almost a consensus among economists that the central bank will not touch rates. It was initially expected that the central bank will march on with its monetary loosening policy, but as you might know from my previous videos, on 19th of March, CHP's Istanbul Mayor Ekrem İmamoğlu was arrested on charges of corruption and aiding and abetting terror organizations. This created a huge shockwave in the Turkish society. Street protests erupted. Main opposition party, CHP, gathered hundreds of thousands of people and still do so in weekly rallies to protest the arrest of Ekrem İmamoğlu and to defend the democracy. Supposedly, this also led to a huge outflow of foreign international investors' positions from Turkey. They almost eliminated their positions in the bond and swap markets. And Turkish retailers switched suddenly from TL to FX deposits. At the end, while estimates vary, central bank lost about $40 billion of its FX reserves. This wasn't supposed to be a huge problem because despite the losses, the central bank had roughly $140 billion of FX reserves at its disposal to defend the Turkish lira, which is the linchpin of Turkey's economic stabilization program. And of course, everyone knows Erdogan's aversion to high interest rates. Gathering this information together, I and most economists said, well, lowering rates in this kind of chaotic environment would give the wrong message that Erdogan runs monetary policy, but keeping rates steady is the best approach. However, central banks surprised us and raised the rates for 300 basis points. Reading the Monetary Policy Council statement, the reasons were, well, domestic demand wasn't slowing as fast as we have expected, and global shocks and the resulting outflow of financial capital made it difficult for us to help inflation. While these are not wrong, clearly they conceal the true reason, which is that, in my view, the central bank governors realized that the political shocks are not over. They will continue indefinitely, and if all these shocks lead to further switches by Turkish deposit holders from Turkish lira assets to FX assets, there was no way to defend the Turkish lira, and we could face a financial crisis. Now, this point is very important. I am claiming, rather speculatively, that the true reason for central bank's decision to raise rates is not that inflation was higher than their expected path, but because they were afraid of more domestic political turmoil. I also add to that they were also mindful of what Trump might cause in the international arena, which I think is one of the main topics that every central bank in every emerging market is debating at this point. If I'm correct, political shocks in Turkey will continue. AKP and CHP will attack each other with all their forces. In the summer, more street protests and regular rallies can be expected to pile more pressure on Erdogan, and in retaliation, Erdogan could sack more CHP mayors or even stage more investigations into the supposed criminal activities of CHP congresspeople, with the result that they will be removed from the Turkish Grand Assembly. Of course, we really should be mindful about international shocks as well. You know how fast the dollar index declined, and there's also turmoil in the United States bond market, which is the pillar of the global credit system. Sell America trade is accelerating. So far, emerging markets benefited from that. Emerging markets equity index rose to the highest level since October, and clearly most emerging market currencies are gaining value vis-a-vis the dollar. Nevertheless, it's not clear whether this escape to emerging markets will last, simply because we don't know how the trade wars will evolve. I mean, if it is limited to United States and China, fine. Ex-China emerging markets, and including Turkey, will receive more financial flows and will have no difficulty managing the affairs of their domestic economy by monetary or fiscal policy. But if Trump sticks to its vow of retaliatory tariffs at the end of the 90-day suspension, and if Trump also decides to punish the countries China uses to divert its exports to the United States, then all emerging markets will be affected. Also, turmoil in the United States bond market could result in a complete freeze in the credit markets, which means emerging nations, their treasuries, and their companies would have a very difficult time to renew their maturing debt in dollar terms. This year, I think this sum is close to $450 billion. In Turkey, roughly $200 billion. So, based on this evidence, I am concluding that unless Erdogan changes his mind and decides to interfere with monetary policy, Turkish policy rates will stay at this level through the summer until the central bank has a clear view of how global trade wars are evolving and how Turkish politics is moving towards a new equilibrium. Clearly, such extended period of monetary tightening is bad for the economy. Before the central bank decision, Turkey's economy was chugging along at its optimal rate, which is roughly 3.5% per annum GDP growth. Current account deficits are very low, and there is really no visible deterioration in the labor market, which means that structural unemployment is high, but seasonal unemployment is going down. In particular, I am mindful of small and medium-sized businesses, which are heavily credit dependent, and the current monetary tightening could lead to an acceleration in bankruptcy filings and lead to losses in employment. Secondly, of course, Turkish consumers, always expecting higher inflation, relied on lower consumer loan rates to buy more autos, houses, and expensive ticket items. Now they are facing much higher loan rates at a time when their disposable income is not growing. So all in all, an extended period of tightening would produce shocks to the supply and demand side of the economy, lowering economic growth. I don't know by how much, because we really have no data how the arrest of İmamoğlu has impacted the economy. It clearly has a huge social impact and changed Turkish political equilibrium, but how companies react to it, whether consumers decide to delay their purchases until the political turmoil is over, is not yet clear. We'll only find out in a month. If companies cancel their capex plans and consumers their plans to purchase homes or autos, Turkey could enter a recession despite what's expected to be a very good tourism season. On inflation front, I think the central bank now has a much higher chance of reaching its year-end inflation target of roughly 25% in consumer prices. So all in all, while the expected lowering of inflation expectations is good, the monetary tightening will hurt Turkish economic growth and employment. And this is where the political aspect comes down. Even by March, before the arrest of Ekrem İmamoğlu, AKP was declining rapidly in the polls. After the arrest of İmamoğlu, this decline accelerated, so much so that on average, as of today, 23rd of April, AKP is now 3 points below CHP. In some surveys, the difference is 6 or 7 points. Put it this way, in roughly 10 polls since the arrest, only one, which is by the staunchly pro-AKP surveying agency Genar, finds AKP and CHP head-to-head. All the other polls, even those conducted by agencies believed to be close to AKP, show CHP gaining momentum. In hypothetical horse races between Ekrem İmamoğlu and President Erdogan, İmamoğlu is now 10 points ahead if he is allowed to contest. But new polls show that even if Erdogan manages to completely sideline İmamoğlu, i.e. ban him from politics, his backup, Ankara CHP Mayor Mansur Yavaş, is as popular and will, according to the polls, beat Erdogan in the next presidential race. Also noteworthy is the rise of CHP Chairman Özel as a potential presidential candidate, which means that even if what happened to İmamoğlu is also applied to Mansur Yavaş, CHP has a third candidate. So all in all, Erdogan lost a lot of political capital by his hasty move of removing İmamoğlu from his way. If the economy slows down, as I expect, polls will show further deterioration in his approval ratings as well as in AKP's standing vis-à-vis CHP. None of these, of course, means early elections, but it would certainly alarm AKP, which might lead to either a political course change or intervention in monetary policy for lower rates or fiscal stimulus to soothe the anger of the voters. Okay, this is all I have to say about central bank's rate hike. I already know the title of my next video, which I will try to shoot in the next few days, which is Can Turkey Resist a Global Financial Crisis? Dear viewers, I am extremely alarmed and frightened by Trump's unpredictability and how that could affect the global credit market at a time when everybody is indebted. we could be talking about a financial crisis, the magnitude of which would be closer to the turmoil we experienced in the first months of the COVID-19 pandemic. Hopefully, it won't reach a level of the great financial crisis of 2007 2008. Thank you very much for viewing Real Turkey channel. Subscribe, hit the button, whatever, send comments. And I want to thank my partners in production, Mesele Economy, the premier economy YouTube channel of Turkey, for helping with this video. Wish all of you a good day. This is Atilla Yesilada saying goodbye from Istanbul.